Lectures number 3 Financial Planning and Forecasting. In these lectures, we're going to learn how to do sales forecasting. Using the percent of sale approach, we will learn how to forecast the amount of assets that the firm needs to invest to support an increase in sales. With required investment in the assets, we will need to calculate how much additional funds would be needed to support an investment in the asset. And in the end, our pro forma balance sheet and income statement will help us to decide how we're gonna raise funds, debt, or equities. The percent of sale approach can be used to calculate how much financing is needed to support an increase in sales. This approach will help us to create a pro forma balance sheet and a pro forma income statement. Under this approach, all accounting items are expressed as ratio of sales. For example, inventories can be expressed as percentage of sales. All other accounting items such as cash, account receivable, account payables, cost of goods sold can all be expressed as percentage of sales. Management can use the percent of sale approach to analyze the performance of the company and identify key indicators for improvement. Or if a forecast based on percent of sale approach shows the sign that the future operations may not be in good conditions, then the management can use this approach to identify the troubles before it happens. The percent of sale approach is a starting point for financial planning and forecasting. First, we're going to calculate the forecast sales as the current sales multiplied by 1 plus the growth rate. We will preview what will be in the lecture. The first step is to forecast sales and prepare a pro forma income statement. We're going to look into the futures, which is year 2013. We're going to forecast the whole income statement in year 2013 based on the percent of sale approach. Then we're going to do a pro forma balance sheet. We will focus our accounting items on the asset side of the balance sheet. Then on the liabilities and equities. The percent of sale approach will help us identify what type of financing the firms will be needed to support an investment in the firm asset. Based on both pro forma income statement and pro forma balance sheet, we would be able to calculate key financial ratios based on the forecasting numbers. And the management should be able to identify what would be the key performance indicator. Will the operations be good or bad in the future? The percent of sale approach provides the management to look into the futures and identify key troubles before they actually happen. When we do forecasting, we need to make some assumptions. In this example, we assume that the firm is operating at full capacity. If the firm wants to expand, the firm must invest in the fixed asset because at current situation, the firm is already operating at full capacity. If the firm wants more sales, invest more in the fixed asset. The second assumption assumes that all assets will grow proportionately with sales. So this is also corresponding to the first assumption. If the firm wants to sell more, the firm must invest more in the asset. We assume that all types of the asset must increase proportionately with an increase in sales. The third assumption, we assume accounts payable and accrued expenses to grow proportionately with sales. In a forecasting process, if we assume that sales are going to increase, then we need to purchase more raw material from the supplier. As a result, accounts payable and accrued expenses will increase. The fourth assumption assumes that the firm profit margins will be retained. What this one suggests is that the cost structure of the firms will be the same. in 2012 and in the future, which is 2013. Also, the financial decisions on dividends payment will be the same. Once the firm expects to make profit, some of those profits will be paid out as dividend, using the same dividend policy, which is 30% of net earnings. And what is left will be retained back into the firm. And for the starting point, we expect that the sales growth will be 25%, which is corresponding to an increase in sales of $500 million. These are the key forecasting assumptions used in our process. Now, let's begin the forecasting process. Let me remind you again that we're going to use the percent of sale method. So under this approach, our first step is to forecast sales. Our most recent financial statement represents the fiscal year 2012. We're going to forecast into the future, which is year 2013. The first item that we have to start with is sales. From the current financial statement, our sale was $2,000. Our forecasting assumptions suggest that sales are expected to increase by $500 million, represent a sales growth of 25%. As a result, we will start with sale, which is $2,500. That represents 25% increase in sales. In a percent of sale approach, we assume that all accounting items can be expressed as percent of sale. So the next accounting item in the income statement are variable costs and then fixed costs. We can first calculate the percent of variable cost to sale in 2012 as $1,200 divided by 2,000, which is equal to 60%. Also, we can calculate percent of fixed cost to sales in 2012 by using 700 divided by 2,000, which is equal to 35%. In step number 2, we're going to forecast variable costs and fixed costs in year 2013. We're going to use a percent of sale approach. We know that variable cost is 60% of sales and fixed cost is 35% of sales. So in step number 2, if we look into 2013, variable cost is equal to sales in 2013 multiply the percentage of variable cost to sales, which is 60%. So the variable cost in 2013 will be equal to $1,500. Next, we're going to calculate fixed cost in 2013. And from the relationship identified based on step number 1, we know that fixed cost is 35% of sales. As a result, forecasted fixed cost in 2013 is equal to $875. Notice that in our key forecasting assumption, we assume that the 2012 profit margins will be maintained, which suggests that the cost structures of the firm in 2012 and 2013 will be the same. Up to this point, we use percent of sale approach to calculate variable cost and fixed cost in 2013. We have identified that variable cost is 60% of sales. Fixed cost is 35% of sales. Based on the sale of $2,500, we can calculate variable cost as $1,500 and fixed cost at $875. We can use sales subtracted by variable cost and fixed cost and get operating profit or earning before interest and tax. The forecasted earning before interest and tax in 2013 is equal to $125 because in 2013, at this point, we don't know how much debt the firm must borrow to support an investment in the firm asset. As a result, we do not know interest expenses that the firm must pay. At this point, we can assume that interest payment will be the same as $16. Then we can calculate earning before tax, which is EBAT subtracted by I. Then we can assume a tax rate equal to 40%. It's 40% of earning before tax. We will have forecasted net incomes. After we get net operating profit after tax of $125, we assume the same amount of interest payment, which is equal to $16. Then we will get earning before tax. To calculate net income, we use earning before tax subtracted by taxes. Our taxes is assumed to be 40% of earning before tax. So we have net income equal to 65.4. Next step is to calculate expected dividend payment. Our key forecasting assumption suggests that the firm will maintain the dividends payment of 30% of net profit. So dividends payment is expected to be 19.62. We can calculate expected earnings that the firm will retain back into the firms. So this calculation completes our forecasted income statement in 2013. Next process is to forecast the amount of the assets that the firm must invest to support an increase in sales. We're going to forecast into 2013. We assume that the firm is operating at full capacity. We also assume that each type of the assets will grow proportionately with an increase in sales. So we expect to sell more in 2013. We must invest more in the assets in 2013. In 2012, we calculate percent of cash to sales, which is 20 divided by sales in 2012. So it's equal to 1%. Then we can calculate cash in 2013 by using sales in 2013 as a starting point, multiply a percent of cash to sales, which is equal to 1%. So we will get cash account equal to $25. Next, account receivable. We first will calculate percent of account receivable to sales in 2012, which is equal to 12%. Then we can calculate forecasted account receivable in 2013. By using sales in 2013 multiplied by the percent of account receivable to sales, which is 12%. So we have a forecasted account receivable in 2013 equal to $300. For the inventory account, we use the same approach. So we're gonna get inventory in 2013, which is also 12% of sales. In this example, we simplify that account receivable and inventory have the same proportion to sales, which is 12%. Then we can calculate current assets, which is the sum of cash, account receivable, and inventory. Next, we're going to forecast net fixed asset. We will start with a calculations of percent of net fixed assets to sales, which is equal to 25%. Then we can calculate net fixed asset in 2013. By using sales in 2013 as a starting point, multiplied by the percent of net fixed assets to sales, which is 25%, we get the forecasted net fixed assets in 2013 equal to 625. And in the last step, we can get total asset, which is equivalent to current assets plus net fixed asset. So the forecasted total assets in 2013 is equal to $1,250. Before we forecast the amount of liabilities and equity that the firm needs in 2013, let's remind the forecasting assumption that we use. We assume that the accounts payable and accruals will grow proportionately with sales. This indicates that we can still use percent of sales approach and we can calculate all these two accounts as percent of sales. First, we're going to calculate the percent of sales relationship in 2012 for accounts payable and accruals. Which is equal to 5%. Next, we can forecast the amount of accounts payable and accruals in 2013 using a percent of sales approach by having sales in 2013 as a starting point and multiply by 5%. We get the expected amount of $125. We are now up to this point, account payables and accrued expenses. For the note payables, long-term debt, and common stock, these are accounting items based on financing decision, so we do not apply the percent of sales approach for these financing items. We're going to calculate them in the end. In this example, we assume that the firm is going to raise additional debt or borrow short-term and long-term to finance an investment in the asset. The firm is not going to issue common stock to finance an investment in the asset. As a result, the firm common stock will remain the same. For the retained earnings account, we need to go back into a forecasted income statement. In the forecasted income statement, we assume that after paying off dividends, the company is going to retain back $45 into the retained earnings. So the retained earnings will increase by $45 from $200 in 2012 into $245 in 2013. The amount of retained earnings in 2013 can be calculated using retained earnings in 2012, which is $200, plus the difference between net incomes and dividends. The firm expects to make net profit of $65.4 and expect to pay dividends equal to $19.6. As a result, the firm will retain back $45.8. But for simplicity, the number has been rounding down to $245 for the retained earnings in 2013. We have forecasted account payable and accrued expenses, which is equal to $125 in 2013. We also assume that the common stock will be the same, $500. We also calculate retained earnings in 2013, which is equal to $245. The last step is to calculate additional fund needed. We know from the balance sheet relationship that total assets are equal to total liabilities and equity. So on the liabilities and equity side of the balance sheet, we have the total amount equal to $1,250. Then we notice that the operating liabilities, which are accounts payable and accruals, are equal to $125. We also calculate the retained earnings, which is equal to 245. We assume that the common stock will remain the same, which is equal to $500. As a result, the additional fund needed will be equal to total liabilities and equity subtracted by operating liability subtracted by the common stock subtracted by the retained earnings. We see that in 2013, the firm needs additional financing equal to $380. It shows that in 2013, the company needs to borrow $380. The firm can borrow short-term and long-term. In this example, we borrow both short-term and long-term. So if we assume that we're going to split 50% short-term borrowing and 50% long-term borrowing, notes payable will be equal to $190 and long-term debts will be equal to $190. This whole calculation process complete all items on the liabilities and equity side of the balance sheet. Now let's sum up what we have done so far. We use a percent of sale approach to forecast the balance sheet and income statement. In this approach, all account items are expressed as the percentage of sale. We start the whole process by forecasting sales next year. Then we calculate the whole production cost and operating cost, which represented by variable cost and fixed cost in this example. After using sales subtracted by variable cost and fixed cost, we get operating profit, EBIT. EBIT subtracted I equal to earning before tax. Remember that at this point, we assume that the interest payment will be the same, $16. However, after we have forecasted an increase in short-term debt and long-term debt, these numbers will need to be readjusted. The whole income statement will need to be adjusted. You will get to practice this adjustment in a case analysis at the end of the chapters. After we get earning before tax, we subtracted taxes, which is equal to 40%. Then we get net income. In this example, we assume that the dividend payout ratio will be the same, which is 30% of net earnings. Then what is left will be retained back into the firms as retained earnings in the balance sheet. Then we forecast the asset side of the balance sheet using percent of sale. We have expected sale in 2013 equal to $2,500. Then we calculate each asset as the percent of sale using the percent of sale relationship in 2012 carry into 2013. Then we complete the whole asset side of the balance sheet. We move into the liabilities and equity. We start with the calculations of operating liabilities. Then we calculate the equities amount. We assume that firm will not raise additional equity to finance an investment in the asset, so the common stock remain the same. Retained earnings just represent what the firm have retained back after the firm pay dividend in 2013. What is left is our short-term borrowing and long-term borrowing. In these examples, we assume that additional fund needed will be financed by borrowing, short-term and long-term. Then we complete the whole liabilities and equity side of the balance sheet. After get a forecasted income statement and balance sheet, we can calculate key financial ratios in 2013. The first part of the financial ratio represents profitability ratios, which in 2013 doesn't look too good when we compare with the industry average. The second group of the ratio represent assets utilization. How many days does the firm take to collect the money from the customers? How many times in 1 year the firms turn over the inventory? And also, with $1 invested in the assets, how much sale is generated? And again, all of these numbers doesn't look too good. What seems to be okay is the debt ratio and the abilities that the firm will generate operating profit to cover the interest payment, which is equal to 7.8 times, which look to be okay to me. Signify here as poor because it's below the industry average. The liquidity position represented by current ratio doesn't look too good. But the firms offer good dividends payment. Okay, so this is the initial analysis based on the initial forecast of the balance sheet and income statement. The additional fund needed can be calculated using the formulas. So this is an example of how one could use a formula. But in our course, we would like you to learn the intuitions behind the calculations of additional fund needed. We will skip the formulas and use the whole financial statement based on the percent of sale approach to do a calculations of additional fund needed, so that you will understand the intuitions behind the whole process. Based on the initial forecast of the financial statement, the management has sits together and review some of the numbers and implicated operating situations. First, what if we expect that the customers will pay quicker next year? Based on a calculation of day sale outstanding, we forecast that the firms will take 43.8 days or 44th day to collect cash from the customers. The management suggests that can we do it within 34th day? If that's the case, what would be the improvement that we're going to see? In a second revision, what if we need an investment in the net fixed assets equal to $700? What we have done so far, the units in the financial statement is in millions dollars, by the way. But we simplify it, just call it $700. And in the third revision, the management said, can we turn over the inventory quicker? Move the inventories out of the company quicker. We're gonna collect the money faster from the customers. We're gonna turn the inventory quicker. This will help improve the liquidity positions of the firms. We should get cash coming into the firms quicker. What happens? These changes will cause an adjustment in the firm asset. The assumption that the management makes so far will need some adjustment in the firm asset. Because it said that it will have no impact on sales and some other business operation, we assume that it will have no impact on the firm's liabilities and equities. By doing this, we will get a revised balance sheet just only on the asset side because no impact on the liabilities and equity and no impacts on the income statement. The size of the assets remain the same. We will invest more in the net fixed asset. And because we collect the money faster from the customers, we're gonna have less account receivable based on the inventory turns over relative to sale. Our new forecasted inventories will be equal to 250. After summing up all the asset side, we see that our cash position has improved. The management suggests the following what-if analysis. First, collect the money from the customer faster. Second, invest more in the net fixed asset. And third, turn over the inventory quicker. Then we have a new forecasted or revised balance sheet which touch on the asset side, and we see a result which is an improvement in a cash account or an improvement in liquidity positions of the firms. Then we can come back and revise the key financial ratios. We see that the number of days outstanding is now revised and the situation is now okay. Inventory turnover will be quicker and the situation is now okay. Our cash position has improved but the current ratio which based on current assets divided by current liability is still below the industry average. So we probably have to make some other adjustment. And because we invest more in the fixed asset, our fixed assets turnover ratio is still below the industry average. Taken together with the total assets turnover ratio, perhaps we need to generate more sales. What else can be improved? Based on a situation that profitability ratio are still below the industry average, we probably need to control more production costs and operating expenses, or we need to generate more sales. And by generating more sales, we should be able to improve total assets turnover ratio and fixed assets turnover ratio as well. Move to the last part of the lectures. We can calculate expected free cash flow in 2013 by using NOPAT as a starting point, subtracted by net investment in capitals, which is equal to negative of $150, or the units in millions dollars. Even though the firms earn positive operating profit after tax, but the firm have invested a lot in the asset. The operating asset. That's why the free cash flow this year provides negative numbers. The management hopes that next year the investment in the operating assets should generate more sales. By the way, this is how we calculate the net investment in the firm's capital. The investment in short-term operating asset and investment in long-term operating asset. In this example, our key assumption is that the firm operating at full capacity, so we need to invest in the net fixed asset if we want to increase more sales. Under this what-if analysis, if we operating only at 85% of capacity, by increasing sales, we can produce more. But we may not have to invest more in the net fixed asset because we're not at full capacity yet. We calculate the capacity sale. Our current sale is $2,000. We are only at 85% capacity. So do the extrapolation. At 100% capacity, we can generate up to $2,353 in sales. Only if forecasted sale exceeds this capacity sale, then we have to invest more in the net fixed asset. In other words, if our sale still less than these numbers, $2,353, we don't need to invest more in the net fixed asset. Why investment in the net fixed asset has some serious implication. You see here, if you invest more in the net fixed asset, you will increase this numbers, and it may cause free cash flow of the firms to be negative. So far, we have seen certain assumption and what-if analysis. If the firms expect to pay more dividends, what happens? We're gonna retain less earning into the firms. As a result, we're gonna borrow more. It will increase additional fund needed. What if we can control production costs and operating expenses, resulting in higher profit margins? With higher profit margins, we will retain small earnings into the firms. With more retained earnings, we will borrow less. How about what if we need to invest more in the net fixed asset? You're gonna need to borrow more additional fund needed. Last one, what if the firm pays suppliers 60 days rather than 30 days? Which is very good. We get to retain some cash. We don't have to pay the suppliers quicker. As a result, these suppliers provide some free credit to the firms. Then there will be less additional fund needed. That's pretty much on the financial planning and forecasting. Hope you enjoyed the lecture.